Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're going to tackle a number that has a huge impact on your financial life, but let's be honest, can often feel like a total mystery.
So let's dive right in and answer the most important question first. What exactly is a good credit score? Because the answer is so much more than just a three-digit number. It's like a key. It can either unlock your financial future or, it can lock it up tight. Let's break down what it really means.
Think of your credit score like your financial report card. In just one quick glance, this number tells lenders a whole story about how you've handled borrowed money in the past. They use this grade to guess how risky it is to lend to you. A higher score means you're a safer bet, and trust me, that is a very, very good thing for your wallet.
Okay, so these scores are broken down into different tiers, right? From poor all the way up to exceptional. Now, the whole scale runs from 300 to 850. But the number you really want to zero in on, the magic number, if you will, is 670. That's your official entry point into the good category. It's where lenders really start to see you as a reliable borrower. So your first goal is to get over that line, and then just keep on climbing.
And that brings us to takeaway number one. While 670 is what gets your foot in the door, the real sweet spot, where the best stuff happens, is 740 and above. Hitting that very good or even exceptional range, well, that's what unlocks the very best interest rates and all those amazing financial products. So now we know what a good score is. But let's get to the really important part. Why should you even care? This is where that number stops being some abstract thing and starts having a real dollars and cents impact on your life. Let's make this super real. Look at this comparison for a $350,000 mortgage. With a good score, you're paying about $2,667 a month. But if your score drops, that exact same loan now costs you over $2,800 a month. That's nearly $140 every single month just because of that three-digit number.
And what about the long-term impact? Oh, it's staggering. That monthly difference really adds up. Over the 30-year life of that loan, a good score saves you almost $50,000. Just think about that for a second. An extra $50,000 in your pocket, not the bank's. That's the power we're talking about here.
And it's not just about the big loans, you know? A good score makes pretty much every part of your financial life easier. Landlords check it when you want to rent an apartment. Insurance companies use it to set your car insurance rates. It gets you those premium credit cards with all the great rewards, higher spending limits. You can even avoid paying security deposits for utilities. It just gives you leverage.
That brings us to takeaway number two. And this is simple but so important. A good credit score isn't just a number, it's this incredibly powerful tool that saves you a fortune in interest and just smooths out all the bumps on your financial journey.
Okay, so how is this all-important number even calculated? It's not some big secret. It actually boils down to 5 key factors from your credit history. Now, not all these factors are created equal. Not even close. Just look at the 2 biggest slices of this pie. Your payment history. Basically, do you pay your bills on time? That's a whopping 35%. And right behind it, at 30%, is how much you owe. Together, those 2 things alone make up 65% of your entire score. It's huge. Let me zero in on that second biggest piece for a minute, because it's absolutely crucial. It's called credit utilization. All it means is the percentage of your total credit card limit that you're actually using. So if you have a $1,000 limit and a $500 balance, your utilization is 50%. This is a number lenders watch like a hawk. So what's a good number to shoot for? Well, the standard rule of thumb is to keep your utilization below 30%. That's considered good. But if you really want to boost your score, the pro move is to aim for under 10%. Why? Because a high utilization percentage signals to lenders that you might be stretched a little too thin financially. So this tells you exactly where you should focus your energy. And that brings us to takeaway number 3, if you can master just 2 things. Paying all your bills on time and keeping your credit card balances low, you've already tackled 65% of what determines your score. It's that simple. Now for the best part. It doesn't matter what your score is today. You are in control. It is not set in stone. So let's talk about the simple, practical steps you can take to build a better score, starting right now. Here are 4 simple but powerful steps. 1. Pay every single bill on time. Seriously, set up automatic payments to make it foolproof. 2. Get aggressive with your credit card balances. Get them way below that 30% mark. 3. Be smart about applying for new credit. Only do it when you really need to. And 4. Check your credit reports. You can do it for free. Look for errors. You'd be surprised how often they pop up, and dispute them.
Now, this is a question I get all the time, and it's based on a really common myth that actually stops people from keeping an eye on their own financial health. So let's clear this up once and for all.
Here's the deal. When you check your own score, say through a monitoring service or your bank, that's what we call a soft inquiry. It has absolutely zero impact on your score. You could check it every single day if you wanted to. A hard inquiry, on the other hand, is when a lender pulls your credit because you're applying for something, like a loan or a new card. That can cause a small temporary dip, which is why you want to be thoughtful about how often you apply for new credit.
And that brings us to takeaway number 4, which is maybe the most empowering one of all. You are in the driver's seat. Your score is just a reflection of your habits, and by consistently doing these simple things, you have the absolute power to build and improve it over time.
All right, we've covered a ton of ground. So before we wrap this up, let's do a super quick review of the most important points. This is the stuff you really need to let sink in.
Let's lock these in. Number 1, good credit starts at 670, but you're really aiming for 740 plus for the best perks. Number 2, a great score saves you thousands of dollars and opens all kinds of financial doors. Number 3, your focus should be on 2 simple things: on-time payments and the low credit card balances. And most importantly, number 4, remember that you are in control. Your habits build your score.
I want to leave you with this one final thought. Your credit score is not a judgment on your character. It's not a label on you as a person. It is simply a tool. It's a snapshot of your financial habits at one particular moment. If it's low, don't look at it as a failure. Look at it as a roadmap, an opportunity to see exactly how you can improve your financial situation.
That's all for now, folks. Please like, share, and subscribe for more like this.